Welcome to our podcast on Accounting Standards Update number 2014-03 on the Simplified Hedge Accounting Approach. In this podcast, we'll go over the private company accounting alternative under ASU 2014-03, including reasons for issuing the alternative and how the alternative is applied. My name is Brandon Cano, and joining me in this podcast is Todd Raven, and we are both senior managers in KPMG's Department of Professional Practice. Todd, perhaps you can kick us off by giving us some background on why this accounting alternative was issued.
The PCC received feedback from stakeholders that private companies often find it challenging to obtain fixed-rate borrowings. As a result, they will sometimes enter into interest rate swaps that allow them to receive from the counterparty based on a variable rate and pay the swap counterparty based on a fixed rate, thereby economically converting their variable rate debt to a fixed-rate borrowing. However, because of the resource constraints a private company may face, they often find it difficult to understand or apply hedge accounting. Additionally, some stakeholders question the relevance and cost of having to determine the fair value of a plain vanilla interest rate swap. So in response to this feedback, the Simplified Hedge Accounting Approach was introduced. Now that we have some background on why this accounting alternative was issued, Brandon, will you take us through the specifics of the Simplified Hedge Accounting Approach?
Sure, will do. The Simplified Hedge Accounting Approach is available for certain plain vanilla interest rate swaps in which the entity will receive variable, pay fixed. One of the main provisions of the approach is that the entity can assume no ineffectiveness. This basically means that the changes in fair value or settlement value are recorded in comprehensive income as long as the swap continues to qualify for the Simplified Hedge Accounting Approach. Now, I just mentioned settlement value because the Simplified Hedge Accounting Approach permits an entity to record these swaps on the balance sheet at settlement value instead of fair value. The difference between settlement value and fair value is that settlement value does not incorporate non-performance risk, so it's easier to calculate. The Simplified Hedge Accounting Approach also provides more time for an entity to complete its hedge documentation. Under the Simplified Hedge Accounting Approach, documentation must be completed by the date on which the first annual financial statements are available to be issued, instead of contemporaneously at hedge inception, which is what current GAAP would otherwise require. Lastly, the Simplified Hedge Accounting Approach can be elected on a swap-by-swap basis. And as we mentioned before, at the end of the day, the effect of all this will be that a private company will be able to reflect interest expense on its income statement similar to a fixed-rate borrowing. Now that we know the basics of the Simplified Hedge Accounting Approach, let's go over the 6 conditions that need to be met in order for the swap to qualify for the approach. The first condition is that both the variable rate on the swap and the variable rate borrowing are based on the same index and reset period. In complying with this condition, companies are not limited to benchmark interest rates and therefore would be able to hedge more interest rate indices such as the prime rate. Borrowings where the borrower has the option to select the interest rate index, sometimes referred to as you-pick-em debt, may qualify as long as the interest rate of the swap and borrowing are based on the same index at inception of the swap and thereafter. The next condition is that the terms of the swap are typical and considered to be plain vanilla, and there is no floor or cap on the variable interest rate of the swap unless the borrowing has a comparable floor or cap. And although the Simplified Hedge Accounting Approach is only permitted to be applied to plain vanilla swaps, the PCC acknowledged that forward-starting interest rate swaps may qualify if the occurrence of the forecasted interest payments to be swapped is probable and the required conditions are met. The next condition is that the repricing and settlement dates for the swap and the borrowing match or differ by no more than a few days. The fourth condition is that the swap's fair value at inception is at or near zero. The fifth condition is the notional amount of the swap is equal to or less than the principal amount of the borrowing that is being hedged. And the sixth and last condition is that all interest payments on the borrowing during the term of the interest rate swap are designated as hedged, whether in total or in proportion to the principal amount of the borrowing being hedged. Now, Todd, perhaps you can round out this topic by covering the effective date and transition.
Sure, I'd be happy to. Moving on to the effective date and transition, the Simplified Hedge Accounting Approach is effective for annual periods beginning after December 15, 2014, which is an entity's 2015 annual financial statements for calendar year companies. An application to interim periods would be in the first quarter following the annual period of adoption. Early application is permitted, and the entity can either adopt the alternative on a full retrospective basis or using a modified retrospective approach. Upon adoption of simplified hedge accounting, an entity must also elect to which existing swaps the approach will be applied to. And then lastly, the final thing I wanted to point out is that although a financial institution may be a private company, it is precluded from applying simplified hedge accounting.
Thanks, Todd. So with that, we would like to thank you for joining this podcast today. We hope that the information provided gives you some insight on the simplified hedge accounting approach. We would also like to inform you that you can find additional information on this accounting alternative and other private company accounting alternatives issued by the FASB and PCC through our Defining Issues publications on the Financial Reporting Network website, which is also where you can find additional podcasts and thought leadership publications on a host of other accounting topics.